Bueno, vamos a empezar.
Well, let's begin. It's already 6:01, especially considering that there are quite a few people connected online. And sometimes when you're online, you're connected, you feel alone when people don't start on time. So let's be on time. So once again, thank you all for being here. We're going to talk about Cobas, what we've done this year. We're going to actually be accountable and try and answer every question you might have. Any question any of you might have from here or from home. We have some news here today. We have Minkun Chang, who for the first time has been able to leave Shanghai, and 3 years. It's been 3 years since he left Shanghai. So he will be talking about our investments in Asia. He will once again give us some brushstrokes on the situation there. And Carmen could not make it, unfortunately, because she is about to be a mom for the second time, and she is in no state to be here today. But she is obviously connected from home, and she will be giving us her support and spirit. So let's look back this year, what we've been doing and the environment, what the situation is. There are loads of uncertainties, as you know. As anything in life, there are no certainties, and it would be too boring if it was certain. And we are going to talk about our portfolio, what we have been doing this year, and we are going to use our magnifying glass and just look about what it is that we have been doing. We are going to explain what it is that we're doing with our campaigns in Asia and our investment funds. Both Vicente and Ivan are going to tell us about this. We will then talk about Santa Comba Group. It's always interesting to see what part of our revenue is then dedicated to those activities that we believe are quite interesting. And we're going to begin with our key figures, which are quite similar to those we obtained last year, with 1.9 billion in management AUM, and in the last 15 months we've actually had very good results. We have actually, I'd say, left behind the bad times. Everything is going quite well and according to plan. Now, with regards to the main news we have to share with you as a company, these are the following. So obviously this has been a pain for 3-4 years. We have had this problem. We will now have a new technological solution that will allow us to have a new website where we have included in ruptura de valor, value rupture, all of our contents, as well as those contents that we have in other hubs. And we have a new private area for our clients, and we said that last year that we would be able to do the onboarding online. So we will be able to register our new clients online, and you will also be able to do regular contributions thanks to these new website. And it has been quite difficult because this is quite special. We designed it ourselves so that we could cover the needs of our investors, of our clients. And very soon, in a few weeks, we will have a new app that will be both available for iOS and Android. So that required much work for everyone in the company, not us specifically. And you cannot hear me. Okay, I'll talk a bit louder. So as we said, this week, we are going to manage an employment plan for freelancers. We have a company's plan and now a freelancer's plan. We see that there is a need for the management of freelancers' pension funds. So it's difficult for a freelancer doing it on his own. So we have now offered this product. We also have a renewed Brain Investor, which is helping investors undertake all of the actions needed and in order to face all of those obstacles when investing, these obstacles are usually things that have to do with personality. We all have the same problems. For instance, we don't want to be part of the herd, and we want to be different, and this app allows us to mitigate that. So these are problems that we all face, not just us, but everyone. And lastly, I wanted to say that we have created now a master's with the ES Business School, and we are talking about the sustainability of pensions. And due to the demographic evolution of our country, as in any Western world country, we think that there should be a mixed system, so that part is guaranteed by the state, but then the rest should be capitalized by each and every one of us. These are the, we believe, more reasonable systems that exist in the world. So we will be contributing to that debate from that subject matter at ESA, which is an independent institution. We could thought to be biased because we manage investment funds and pension funds, but we're not. Actually, we're quite neutral because it's not an essential part of our business, and we don't do it. We don't do it much because that we have a limit to manage, and we don't have the need to attract capital or investors. That's with regards to current news. And obviously, I was forgetting about this. We're already preparing the launch of our new Class A that will begin at the beginning of next year. So our commissions will go down for everyone who has been with us for 7 years as a client. It will go down to 1%, both for funds and pension funds. And we think that 1% in the long term is a very good rate, very good fee, very reasonable. It's not too high, not too low. It's fair for everybody. So that's how we see it. And we would rather distribute our income with our clients and not with distributors or third parties. That is part of our philosophy. And the performance of our funds, fortunately, last year and this year, it's been quite reasonable. Last year, for the first time since we are at Cobas, we had a positive profitability in the market, although we had loads of problems during the whole year. And I have to say that should always be the case. We cannot sign a contract anywhere for that to be repeated, but that should be the normal situation. If we look at our portfolio with the prices in the market and with and how attractive that is, obviously we should a good profitability. It's true that there will be difficult times, such as what happened with COVID. There are things that are unsurmountable, and that big portfolios can always withstand everything. But when there is a recovery, when we're buying assets at low prices, it has to be performant. And with that, we have managed to recover all the losses that we had in 2018 till 2020, and they were quite important. And we think that we have set the basis for what should be a reasonable profitability that is based on the quality of the companies that we have chosen, and we have reached our historical our minimum record with regards to upside. We have gone from 180 to 240 in our international portfolio. And the thing is that when we're losing, such as we were in 2018, 2019 with all of our companies, we couldn't really work on the portfolio. We had to just be patient. And when we had strong movements, such as the ones we saw last year, then we could sell certain things, buy some others, and generate value in that trend. And in the downside, we always say, or the lower line, we say that we cannot work because we have to be a bit of a psychologist. We have to understand why we do this, why we do that, why some people cannot see the value that we see, but that's all we can do, have that pedagogical action. But we can act on the green line, which is the one that we're always working on. That's the line that we work for. And I'm going to answer to your usual question. When are those two lines going to merge together? It will never happen. So those 240 that we currently have will be 270 next year. And in 2025, they should be 300. And that is an amazing magnet when you're buying assets. When you're buying assets at 30, 40% of their real value, only good things can happen. And I'm absolutely sure of that. And that's what we need to work on. And we will see. Now, the timing, we don't know. That's another big question that you always ask me. When will that happen? After 6 flat years, when are we going to see a rise in value in those funds? Well, we can't tell. when I was in my previous stage before Cobas, we had long periods such as this, 6 flat years. And although there are very long flat periods, in the end, after 15 years, you do have an 11% profitability. And why is that? Well, because profitability is achieved during a very short time. A yield is achieved in a very short time and in a violent way, I'd say. You cannot foresee when that will happen. So what can you expect? Well, that 99 should become 240 step by step, and sometimes it'll be 10%, sometimes it'll be 35%, sometimes 5, sometimes minus 5, but the yield has to be better than average, because the value we find in our funds right now is actually very important. And what we did in the international portfolio has been mirrored in the Iberian portfolio. We have the same situation, so the potential is actually quite similar, but the Iberian has behaved better, so it has a bit less upside, but it is an amazing upside anyways. And there is something important and interesting about these two things. I mean, the green lines may go down. The valuation of our companies might go down. For instance, here we see the drop we had in 2020 due to COVID, and the valuations of our companies went a bit down. But these drops in valuation are relatively small because we are not tricking anyone. We just look at the value of the company itself. So sometimes we might make mistakes in certain companies because we have valued them too high, but in other cases we value them too low. So in the end, there is a neutral effect thanks to all of those mistakes. So from my point of view, the future looks, I'd say, pretty good. And now, what is the basis of our valuation? Well, we have here our multiples, and here I would talk about the P for 2023, and Vicente and Minkun will talk about that, but we have 6 times profit, and the market is negotiating at 30 times. Standard & Poor's for the US is 17 times. So we're talking about very, very important discount compared to the market. Market might fall 25% as it fell last year during the month of September, but we were in positive figures, and that's normal because if you purchase companies at a PE 6 that are creating cash flow during those 6 years, then we have the same situation. But that was the Iberian portfolio. We're talking about 7 PER, but we're not talking about companies that are just breathing their last breath before they die. No, these are companies that have amazing return in a market economy such as ours. So we're talking about very good companies at a very good price. And that is the basis of our work, trying to find those companies, not trying to know what the market is going to do, because nobody will ever know what the market will do. We only try to find good companies and see why the market is not valuing them as they should, when they're not giving them a 15 times, but rather a 6 times, when they should give them 15 times. And now let's talk about the environment, because people always ask us about global growth forecast. What can we expect about that? Well, 1% in Europe and the US. We talk about whether there will be recession, whether there won't be recession, +1, -1, +0. It's difficult to predict, and even more so in the short term. And there will not be an extraordinary growth in Europe or in the US in the next few years. I'm sure that there will not be amazing growth. It will be limited growth, if any. But fortunately, we have important economies that are growing at a 5% rate, especially in Asia, and especially the biggest countries in the southeast of Asia, including China, obviously, but also India and Indonesia, the Philippines, Vietnam, Malaysia, and so on. So we're talking about 3 billion people. So it's an amazing amount of people trying to be better and having a better life on the daily, and improving the situation and learning from what we did in the Western world and applying it there. So those elements allow us to have a 2.8% growth globally. So this average growth rate since China has liberalized itself was 3.5%, but now it's 2.8%, and during the next 10 years we will have 2.7, 3.3, 3, growth, average yearly growth, with the support of developing countries and emerging countries, and with growth in Europe and in the US that will be moderate and lower. But as investors, we understand that we don't have to just zoom in into certain elements. When we read the newspaper, we only read that there's crisis and crisis all around us. Well, yes, there are European countries in crisis. In the US, they have an important debt problem as well. So obviously, yes, we need those informations because we need to know what the situation is. But we also have to look at what happens in other places. And what really matters is that 2.8% growth globally, 2.8% increase in demand for everything, or depending on what product we're considering, and that is what allows us to have the right criteria to invest the world over. So why do these countries grow and we don't grow? Well, the main reason is obviously because they haven't applied the technology that we have applied for development, and they're doing it now. So that will help them grow step by step. But there's also something very important, which is the fact that what has been done in the US and in Europe in the last 15 years has been tremendous. The US debt has evolved, especially since 2007, 2008 until now. The monetary mass in Europe has also increased very much. We see that there is an exorbitant growth and public debt as well in EU, and the monetary mass in the US as well. So that is what generates inflation in the end. That's monetary mass is inflation. It's just issuing banknotes. It's been incredible, the development that we've seen in the last 10 to 15 years. So obviously, when this happens, getting out of that situation is very complicated, and that is what we're seeing in Europe. We have to choose between inflation or public debt, because obviously inflation helps me because it allows me to reduce the public debt. And the Spanish example is actually very clear. Thanks to that 8% inflation last year, our GDP debt has gone from 20% to 13%. So not because we have stopped spending and because we have restrained ourselves. No, we were spending much more. But the thing is that now inflation is hiding that public debt. So there has been an increase in taxes for everyone. It's been covered up by inflation, but it's been an increase in taxes, and getting out of that is very complicated because you have inflation on the one side and public debt on the other. So why don't we have inflation problems or interest rates going up in emerging countries, especially in Asia? Well, because as we see here, they had not reduced their their interest rates. We see the green lines in the US with flat rates during the last 10 years. I'd even say 15 years since 2008, and interest rates in China and in India. Well, India could be reasonable because it's a country that has some inflation, and obviously you could think that the next interest rates are high naturally, but in China that's not the case, and they have had interest rates higher than those that we have had in the US and Europe in the last few years. And what happens now? Well, they don't have an inflation because they haven't increased their monetary mass in the last few years as we have done, and they haven't increased their public debt in a crazy way as we did here, because they couldn't do it, because you cannot give 1,000 euros to every citizen as they did in the US, or paying for certain things that, as we see, are not sustainable. With time we saw it, because we have to pay for that either via inflation or some other way. So they don't have to solve those problems because they didn't create them. So that is not having a negative impact in their economies, as we are seeing in Europe and in the US, and without really knowing what the consequences of that will be. Because when we go from interest rates at 0% to 4, 5, 6, we don't know what problems that will cause and where those problems will be caused, because we don't know, as Warren Buffett said, who is naked when the tide goes down. We don't know who will be in a difficult situation. So we will see how that can be resolved in Europe and the US. Fortunately, these economies seem to be able, those non-European and American countries, not the US, could be an anchor for the economic growth.
So what do we do in this context? We are from Spain here, and we've always said that it's nicer or easier to invest close to your country, even though we have Minkun over there in Shanghai, and he's keeping an eye on everything, but it's easier to have everyone gathered around here. And the further you go from home, the more complicated it gets. At any rate, and in spite of that, we have managed to hedge in two ways. Firstly, we have done some geographical crunching as to where we sell our products. Products in our portfolio are 70% global. We sell them the world over, also in Europe and in the United States, but we target global markets generally. If there's a drop in demand, that can be offset by an increase in another market. So we are not excessively concerned about what happens in the United States and Europe for that 70%. And now consumer goods companies in the United States and Europe, we do have some of those. We have companies of several types indeed, but the specificity is that in that 30%, out of that 30%, I would say cyclical consumption could amount to 1/3. It would be perhaps 10% compared to a very stable percentage of consumption. For instance, Babcock in defense, especially in the United Kingdom and also in other countries, or also there's another company that depends on nursing homes too. They're based in Italy chiefly. So these are particularly defensive sectors in which a growth of 0 or 1 in Europe shouldn't have a great impact. So that's the first protection that we have against a negative environment in Europe and the United States and globally too. And the second way to protect ourselves, to hedge, is mainly against inflation. In my book 7 years ago, I was explaining how for any saver, the main problem will be inflation and will always be so, of course, because there is a natural trend to print money, and they want to be reelected, and because they constantly wanted to be reelected, the best way to go about it is to spread money around. So there's a natural trend towards inflation. Unfortunately, in those economies where there are elections every certain time, that's the trend. So we hedge by investing in real assets, which, as we've always said, is the best way to be hedged. And that means owning things, not being lenders, but rather owning things. So in our portfolio, what we do is to own 35% energy and commodities too. There you have very direct coverage or hedging because it increases the end product of what you're selling. And then we have a quasi-direct hedge in equity by owning equity-based companies. And there you have practically direct hedging. And this is proving itself too. Why? Because companies are increasing their product prices. There's inflation, and you need to buy 5% more to your employees. You just increase your product price by also 5%, and at the end of the day, you end up making the same money. And we have very clear examples in our portfolio. For instance, our dear ETSA, a company that has been quite problematic, but now it's in the right track. And they say that now prices are increasing. Well, this is public news. They're increasing by 18%. You see that on the price of bread. It's not even necessary to have a super sophisticated app or very specific type of product for which rocket launches are essential. You can see that on the price of bread, and you can see that on Aldi and Lidl, all the different supermarkets. It's not just your corner shop. It's with the harness negotiators that you have in the market. So if there is inflation, companies just increase their prices, and they are on par. They are as they started, and we consider that we're reasonably hedged against inflation through these different actions. And actually, to show you an opposite example, who is not hedged against the inflation? Those that have a deposit in their bank at 1%, 2%. If there's an inflation of 5% per year, you have had 6% expropriated without even realizing it. So that's what it is. Now, about our portfolio review, there's been some slight changes, not substantial ones, but there's been some slight changes. We have reduced our exposure to energy chiefly. It's performed quite well last year. This was very helpful, especially for infrastructure and transport of oil and gas. oil tankers and natural gas ships. For those, we have reduced our exposure to that industry. Practically everyone is now aware of how important they are, how much they're worth, and now the market is recognizing that. We continue to keep LNG infrastructure. So we have had a takeover bid on a company, Xmart. We'll probably sell. That exposure will be reduced, and it'll be kept at $1, and that's our greatest exposure. Later we can talk about it, if you will. We have had an increase in oil and gas producers, because this is something that we explained in detail last year too. With rational petrol at $60-65, we considered that this is completely undervalued for the companies that we have in our portfolio. And this is the exposure that we have. 16% of the real exposure for the oil price right now. It's 12% of the portfolio. And we have had an increase in defense, pharma somewhat too, defense and consumption too, for cyclical companies too, chiefly actually last year when markets were experiencing very significant drops. We went about this in October, and we did this case by case. It's not that we want to increase drastically in cyclical companies, but in companies that have decreased about 60-70%, it might be interesting to make the best of the moment to buy into cyclical companies. And we've also had an increase in commodities, also case by case. So these are the key factors for our portfolio. Also for the VRM portfolio, we have had changes in our exposure to energy, and we have increased in our exposure to commodities chiefly, because once again we are significantly investing into Atalaya. It's one of the most significant companies in our Iberian portfolio for the Rio Tinto mines. They are very famous over the course of history. Actually, they have been. And here you see how we have experienced a slight decrease in defense, there's very specific cases here. So this is the portfolio review. This is how it's structured right now. And before I wrap up and give the floor to other colleagues who are going to be talking about specific cases, I'd like to make a mention of Cobas Renta. This is something that we were already considering doing before the different crises that are experienced in the different American banks week after week. But this is very interesting in terms of the deposits and fixed income too. There's different features behind this fund. The first being that the greatest part of the investment is done on German sovereign bonds. And these are probably the most reliable sovereign bonds in Europe. Their yield, the IRR is not really that high, is 2.2, but from nominal perspective, it's still significant. And then the remaining is split into two different types of assets: high yield debt that provides a very high yield, or IRR, and also equities. And high yield debt is at 11%. For those companies in which we are shareholders, we know them extraordinarily well, and if we are shareholders, it's because we think that there shouldn't be any financial issues, and it doesn't make sense for them to have a yield of 10-12%. And all of them have a 4-year duration, 3 or 5 tops. So we are with an annual yield of 10% for that portfolio in a term that runs from 3 to 5 years, and that's really good. And even some of them have net cash. I mean, yield for the bonds of 8-9%, having 300 million in debt, both those bonds that we own, and 400 million in current account. And the bond is yielding 11%. And that's the way the market is behaving right now. And these companies are normally in the field of fossil fuels, and because they are facing so many restrictions from so many people. So that's how these opportunities arise. And we mustn't forget that the management fee at Cobas Renta is 0.25. Well, we need to get a little bit out of this. We need to put it on the table, but we're not there to consider this a great source of income. But it does add value in very many cases. And actually, there's no reimbursement fee in this fund, so it can be reused not as a bank account, but quite in a flexible manner, nonetheless. So now I'm going to give the floor firstly to Min Kung, then to Ivan, and then Vicente, so that they can talk to us first about Asia and then about two other companies. Espero que se me...
Buenos días a todos. Soy Min.
Good morning, everyone. I'm Min Kum. I'm part of the investment team at Cobas Asia. I'm delighted to be here in Madrid once again after over 3 years due to COVID. And today, I'm going to share with you our investments in Asia. Firstly, general overview. We have 11 companies in Asia. Almost 12% of Cobas International. All of them are family-owned companies or have a control group behind them. So we're in good hands. They're good business with a weighted average ROC of 24%, and they have a safe balance sheet. 9 out of 11 have a net cash position, and finally, they are trading at 3 or 4 times PE with an upside potential of over 100. As you very well know, a great share of our investment in Asia focuses on Japan and Korea. And I am going to tell you what we are seeing in those markets. Now, in Korea, governance has improved in the last few years. For instance, out of the portfolios, out of the companies in the portfolio, we see that many are doing buybacks. For instance, LG Corp, Kia Movies, and KT. And some are actually canceling their own treasury shares, such as Samsung CT and Hyundai Motor. In addition to that, the government is becoming more aggressive to foster change. Actually, just 1 month ago, the government officials working at the stock market starting presenting to foreign investors different messages. First, the first message was that investing in Korea will be easier going forward. And the second will be that they will protect the interests of minority shareholders, and they will encourage Korean companies to become better for shareholders too. Why this change of governance? Well, this probably has to do with the fact that there's an increasing amount of Koreans investing in the stock market. As you can see on the chart, the number of minority investors has more than doubled in the last 3 years. In other words, the wealth of the majority of the population with voting rights is now exposed to the stock market, going up from 11% just a few years ago. Therefore, the government is interested in better corporate governance and having better corporate governance in Korea. Now, let's talk about Japan. Japan has been a very interesting place for value investors. The number of companies with a net cash is on the rise. Actually, the net debt is dropping, and actually purchases in Japan hit a record mark last year. We think that this trend may go on. On the one hand, the government, just like in the case of Korea, is pushing for better corporate governance. And recently, the Tokyo stock market sent a letter to the companies that are listed in their markets so that those listed below accounting value present in writing, for them to present in writing every single year the measures that they're going to implement for a better capital allocation. This is the first time that this happens in the history of Japan. And on the other hand, investors that are very reputable, such as Warren Buffett, are starting to be present in Japan. So all this fosters that Japan becomes part of the radar for many investors. And here you have a list of the companies. Let's talk about the top 5. Firstly, we have Samsung C&T. It's a holding of Samsung Group. Actually, the most important asset here is value electronics, and the memory sector is very relevant here. Now, demand for memory is the minimum of its cycle, whereas the supply side is behaving in a disciplined way. There's just a few players, just 3 of them there, and all of them are working with a capex. Now, this is very positive once applied the adjustments. Now, then we have LG Electronics and LG Corp. We talked about them very recently. Actually, last year we mentioned them. So I want to elaborate on them now. And we also have Ichiko. Ichiko is a new company which we purchased last year. It's a Japanese company that provides lamps or lights for cars. And Toyota and Nissan are its best customers. Now, a very important part of their sales are done in Southeast Asia, a market that is on the rise. We also have CKH, which is the holding company of the Lee family from Hong Kong. They have a very diversified business. For instance, it includes telecom business, infrastructures, ports, and retail. It's a very diversified business indeed. This is something that we shared in the October webinar that you can actually watch on YouTube. Let's talk also about Daiwa Industry. It's one of the top 3 players in Japan for commercial or retail refrigerators. Now, retail refrigerators is a very stable business with a very high ROIC. Now, China reopening will cause tourists to get back soon, and this will be great news for Daiwa's business. And that was all from me. Thank you very much for your kind attention, and now I will give the floor to Ivan.
Thank you, Min-kun, and good afternoon, everyone. My name is Ivan Cevedine. I am also part of the investment team, and today I'd like to start my intervention with a question that will maybe allow us to better think about how illogical a short-term market can actually become. And with no further ado, we will begin. Do you believe that there could be a question, or that the market could give us the opportunity of purchasing a company that having 75% of its market capitalization in cash, and that having technology that helps reduce CO2 emissions, and that has an order book that is at an all-time high and that is always growing every quarter, could be trading at 2-3 times revenue? Do you think that the market could give us that opportunity? Well, it did. It did give us that opportunity, and that company is called Danieli. And maybe the most interesting thing about Danieli is that you and us as well, as investors, are now partly owners of this company. Thanks to our international fund, we now own almost 3.5 or 4% of our international fund is invested in Danieli. But since I'm sure you're asking what does this wonderful company do, then let me describe it for you. As I'm sure you've realized due to its name, Danieli is an Italian company that is controlled by two families, the families Danieli and Benedetti, and it has two businesses. The first one is the design of plants. It's plant making, and it represents 2/3 of their EBITDA, or their operational revenue. And what does this division do? Well, this division designs and builds steel plants. And this is, I would say, a monopoly and oligopoly, where three companies control 70% of the market. The other division is that of steel manufacturing, steel making. It's like Arcelor, but with specialized steels. And what's most important about this division is that it has a competitive advantage. And Danieli has that competitive advantage, and they can test their technological developments in real life, in plants that are working, not just in pilot projects. And I know that just telling you that Danieli designs and builds steel plants could be a bit too complicated for you to visualize. I'm going to show you this in a more graphic way. It helps us transform that into this. I don't know how many of you know that the steel sector represents 8 to 10% of CO2 emissions globally every year. To better understand that, I am going to try and explain to you how steel is made nowadays. Well, basically, there are two ways to produce steel. On the one hand, you could use minerals, or you could use scraps. And the process that uses minerals is called a blast furnace. It's an amazing furnace where you have minerals, you have coal, and you get steel out of it. But the bad thing about this process is that for every ton of steel, you produce 2 tons of CO2, and that represents 70% of the world's production. And the other process is using scrap. And the electric furnace is being heated with electricity. You introduce your scrap and you get your steel. It's a much cleaner process, and for each ton of steel, depending on the technology you use, it produces 0.4 to 0.8 tons of CO2. So the logical question would be, why don't people produce with scrap rather than iron? Well, the problem is that there isn't enough scrap to produce as much steel as is needed worldwide. But don't worry, because our future steel will be using an intermediate solution. DRI is about taking oxygen out of the iron mineral and having pure iron. And iron could replace scraps, and we could use it in our electric furnace. So we could use it as if it were scraps. And to summarize this, which might have been a bit too technical, Danieli builds any sort of steel plant, but they are now focusing on solving the lack of scrap problem, and they're now focusing on having the whole productive process becoming free from CO2 emissions. If we use hydrogen in this process instead of iron, and if we use green electricity, then the whole process would be free from CO2 emissions. So summarizing our investment thesis, I would say that investing in Danieli is an investment with a minimum risk. I cannot say, obviously, that there is zero risk, because there is no such thing in life. We're the company that we have known for a very long time, where two families have had a long-term vision, and they knew how to position themselves in the segments that would have the highest demand in the future. And this is a company that has tailwind. As you can see, their portfolio and their order intake has not stopped growing. Why? Because electricity companies are decarbonizing their process, and this is possible because governments are also giving them the support they need with subsidies. For instance, Arcelor and Thyssen have gotten subsidies from Spain as well as Germany, and in the short term we have the possibility as well of simplifying their structure, their corporate structure. Daniele has two kinds of shares, and the family would like to simplify that situation. We think that that could help us breach the gap. And as a conclusion, I would say that Daniele is a very good company that is not being paid as they should. They're only paying 2 to 3 times return to this company. So we think it's a very good idea for investment. And that's all I wanted to share with you. And I will now give the floor to Vicente.
Muy buenas tardes a todos. Gracias por...
Good afternoon, everyone, and thank you so much for coming to this event that we organize on a yearly basis. I'm going to try and explain to you our last investment case. It is a Norwegian company called Wilhelmsen Holding. We have 3.8% of the international portfolio. We're going to try and explain what it is, what businesses they hold, and we will give you some brushstrokes on its valuation. In the first place, this company was founded in 1960 by the family Wilhelmsen. So this is the 5th generation of the family. Their CEO, Thomas Wilhelmsen, is the one at the wheel in negotiations. They have businesses with leader positions the world over with regards to logistics and transportation. It's a holding that has a net cash flow. And as for track record, this is a company that has been in the stock exchange for 40 years with a value creation that represents around 8% of their annual profitability. Ever since it was listed, their growth is around 9 to 11%, which means that they've been doing things right. And as for business, the main businesses are 38% that they have of Wallenius Wilhelmsen, which is for sea transportation of either cars or heavy goods. They represent 40% of the world capacity for transportation. They do it thanks to 130 ships, and they have logistics centers as well. So when you get to the harbor, the logistic terminal belongs to them. So they receive the goods, they can load them in the ships, and then they send it to destination. And in destination, they also have the hub, and they can distribute them. They distribute the goods to the final customer. And who are their clients? Well, automotive companies, and the biggest companies such as Caterpillar, Volvo, Scania, that we all know, and the government as well, that sometimes need some transportation capacities for heavy equipment or for armament. So it's heavy duty loads, and they have a sustainable growth, and I would say that it is it's reasonably similar to the world trade in the long term. And the second company we have here is a company that they totally own, which is called Maritime Services. They are not listed in the stock. And what do? Well, they provide support to their world fleet. They are present in 2,000 ports and harbors worldwide, and what they do is manage their fleet. They file the documentation in customs. They hire the staff and maintenance, as well as everything that would be needed for a safe and efficient management of ships, such as spare parts and so on. So it is a company that has a very high quality, and they have a return of around 30-40%. So it's a debtless company, and that's actually very good. And I would even say that this company also produces goods for the cleaning of the ships, and they have chemical products, and they do everything that is needed for a ship to work efficiently and safely in the day-to-day. And that is what they do with their maritime services company. And then they have 8% of Hyundai Glovis. Hyundai Glovis is a company that is followed by Minkun, my colleague. And because he's closer to the company since he's in Asia, that is the logistics arm of Hyundai. It is a very big company with a capitalization of around 5 billion. And they don't just transport Hyundai cars, but also third-party cars, and not just cars, but also, for instance, dry loads, raw materials, components. It's a very good company that have seen a growth in their dividends on a yearly basis. They have other businesses that are starting to grow as well. They have logistic base in the north of Europe where they give support to the European fleet. And with regards to renewable energies, they also have business to provide maintenance to renewable parks. They're developing that right now, and they have been in that sector for a couple of years now. As for evaluation, what does this company look like? Well, first off, we would have to say that if we consider all of the profit of all of their subsidiaries, it's 3 times net profit. Just like with Danieli, that has 2 to 3 times net profit. Well, this one has 3 times net profit, so it's a very attractive company. How can we reach a valuation so that we understand the situation? So the cash is actually interesting, 66 million. Then we have 2 listed subsidiaries. We have WAW, which is around 1 billion, and then Hyundai Glovis, that is around $400 million. Then Maritime Services, that is wholly owned by them, that is around 7 to 8 times EBITDA, and I think it's a very reasonable value for a company that is growing and that has a good return on the capital that they employ. Then they have some other assets, such as the ones that have to do with renewable energies maintenance, so that would, if we are very reasonable, would give us 2.4 billion, but with the market capitalization it gives us potential that would be twice as much. And if we consider WAW and Glovis, then the upside would be more than that. It would be 3 times that. So this is a very safe company with a very good balance, with a family behind it, with an owner that has been doing a very reasonable management of all of it, of the whole group. And how come this is so cheap? There must be some problem. How do we solve this valuation gap? Well, we think that the company and the subsidiaries are generating many dividends. We think that they will receive around 15 to 20% of the current capitalization in dividends, and they pay dividends at 4%. So we think that there is margin to pay a bit more or to repurchase shares. And actually yesterday the company announced a repurchase of shares planned. They did one in 2019, and yesterday they announced another one. So it's all steps in the right direction to close that valuation gap, and we think it's a very good opportunity. So in the end we will be owners not just of a little paper, but rather of pieces of businesses, and the price that we pay is 3 times that, but the value that we get is very good, because after the 3rd year this company would have cost us nothing. So that is why we think it's very attractive. So those are the examples, the investment examples, and I will now give the floor to my colleague so that he may finish. Thank you so much. Thank you to all of you. In the case of Wilhelmsen, we have to say that we have insisted for a very long time with the company. We have so that we could close that valuation gap, and the announcement that they made yesterday is actually the result of the fact that some shareholders, some are a bit more aggressive in Norway, and as well as we have been working in a softer way, have convinced the company to close that valuation gap, because we mustn't be just sitting in a passive way. We should always propose reasonable things, such as the repurchase of shares, because that is really attractive due to their valuation. And I also wanted to highlight that with this overview of 20% of our portfolio, we realize that most of the businesses where we're present, and we don't highlight enough, we have world leaders in their own segments. As Jack Welch said, we are either the first or the second in each sector. Wilhelmsen are the first one in their 2 main business. Danieli is the first one in the steel plant business, and the Asian companies, well, there are lots of different examples, but that is the situation where either the world leader or the country leader. If you're a distributor or so on, that is also very important. So we always look for those companies. And after having talked about all these things, and before we finish, we should now talk about Santa Comba. And we will finish with Cobas Pensiones. Cobas Pensions, we have said that we have launched a new pension plan for freelancers thanks to the Association of Financial Planners. We are going to do that hand in hand with them, so that all freelancers who wish to do so can access this employment plan that is managed by Cobas. by Cobas Asset Management that is led by Cobas Pensiones. And we have launched a private area for companies. So companies may now offer their clients employment plans, and we have given them all the tools, everything that is needed for them to be able to manage that with their employees, because those are things that are sometimes done manually. So they're getting that ready. And we are around 100 million under management. So our pension business is growing little by little. And now with regards to Value School, that we have done a couple of things and there are some milestones. It's quite surprising to see everything that we are doing lately. And our trajectory is actually quite outstanding, with 8,000 people registering for the Value Academy. We are going to have an executive program in value investing that will be a bit larger. We have some weekly pills, information pills, but now we're going to do something a bit longer for companies. As you all know, we are going to be doing some workshops that are being paid for by Fundae. So it's an educational project that we're putting in place, and it's always very interesting, but it's even more interesting if it's subsidized by public institutions. And then the podcast as well, they have been downloaded 2.5 million times, and we have thousands of followers. Value School has thousands of followers in social networks, and I want to thank all of you who have contributed. We have people from the sector, from different companies, and they have done so for free. They all have contributed to providing content for Value School. And with all of these initiatives, we allow for that to be self-financed. We are not dependent on third parties, and that will give it a life, I hope a long-lasting life. And now with regards to social impact investments, that is our impact management group, that is the sister of Santa Comba. We can't really talk about that because these are free investment funds, but after launching the African fund, we have launched a Spanish fund with parties that participate in it that are very interesting, such as Eco, London, Ilunion, Repsol, very interesting partners that have allowed for the fund to be launched. The FEI, the European Investment Fund, is also going to be part of it, and we know that the objective is not maximizing our yield, but rather having a reasonable yield and to do things beyond that. So in general terms, what we want is to improve the lives of people. So helping people who are in vulnerable situations, or companies that are focusing on helping those vulnerable populations. And although those companies might not be just non-profit companies, but rather companies that work for sustainability. And finally, open value that also feeds off Santa Comba. In our venture philanthropy, what we do at Open Value is finance smaller companies that could at some point be companies that could be interesting for our impact funds. But these are smaller investments with that philosophy of always helping people who need that support. And we have been measuring the impact, and we see that there have been over 1,000 direct beneficiaries in Spain and Africa. So we can actually tell that there's an effect now after a few years, and it's just like the Acumen Fellows. We have 22 new Acumen Fellows. Lots of people are following those courses with everything that requires. We are simply defending these principles of social impact. And then we have 5 other projects that are being funded that are also philanthropic projects that we are leading. So there are lots of different activities, and we have to congratulate everyone for the job that they have carried out. So, and in order to end, I would like to conclude by saying what we have been saying from the beginning. We have obtained target values since the inception of the funds, and as I said, we're talking about peaceful situation, because in 2009 we had seen a 60% drop. Obviously, we had a 300% potential, but in a normal situation such as the one that we're living in right now, well, reasonably normal, because it's never normal, is it? So in a reasonably normal situation, having a 150% potential and keep on growing is actually quite attractive. And we also know our portfolio quite well. We have to insist on that. We are talking about leaders, companies that are leaders in what they do, world leaders, and at very, very low prices. It's impossible to find in the private market things that we find and that are in our portfolio, because nobody in their right mind is going to sell a company such as Danieli for $1.6 million when 1.6 billion. They will sell it for 2.5 billion. So that's the luck we have. We invest in that market, and that's a unique opportunity.
And the advantage of being shareholders for 4 or 5 years for the companies and having 15 years worth of relationships with those companies is that the level of certainty at the portfolio is very low, not just from the potential standpoint, but also from the qualitative standpoint too. It's difficult to convey this idea, but really the feelings are very strong there. Actually, personally, for me, this is in place since the summer 2000, and even before the fund started recovering, but this becomes acceptable over the course of time. Actually, with Angola, we have met with the president in Madrid and London twice in the last 2 months, and with the CEO, the general manager, once in Norway in March. So we can actually be proud about the fact that we are one of the few investors that know these companies best, the companies that we invest in. And that's what we have to do. What the company does, why is it cheap, what is your contribution, what's the differential, how is the gap going to close vis-a-vis the valuation that you have in mind. So this is what provides knowledge and certainty for us. And things are the market started to recognize the value of our assets. We have undergone in the last 2 years 2 takeover bids that were significant. Curiously enough, in the NLG gas, and you know, when the Ukraine crisis came about, we had been invested in this market or in this industry for quite a few years, and we had been invested in methane transportation business or natural gas transportation business for over 3 or 4 years. So our situation was very good because we had great knowledge about this, and the takeover bids of Exmart and Gaslog favored us. We publicly said that the Exmart takeover bid seems acceptable, and we're going to sell our shares. And this is interesting, and I'm sharing this because this is going to increase the value of the fund automatically. Why? Because Exmart is 12 years, and for us it's worth 3. So it's practically at its value. So for us, it no longer makes sense to be there as a shareholder. But with those shares, when we sell them in 1 month or 2, whenever the process materializes, we will reinvest in the rest of companies of our portfolio. What is it that we will do? We will be investing in companies that have 100% potential if we invest in our portfolio as a whole. So our the fund of the value of the fund, instead of 250, will be 257, and the money that is there at Exmart, and it's flat right now, and it already provided yield, it will be put to work for other companies. So the good thing about this is that we're creating value by different moves of the portfolio. The takeover bids were acceptable. Gaslog's takeover bid, in spite of the fact that we clearly obtained reasonable deals, we bought at 4, and the takeover bid is at 8 or 5. We'll be voting against because we think that the company is undervalued, and for us it would be worth it to continue to be a shareholder. And this has happened in the past. There's been takeover bids that we were not interested in, and we didn't participate in them. So the market continues to recognize things slowly but surely. And what I'm sharing here once again is just the story that I mentioned now. We recycle some companies into other. It's systematic, and it's the way it should be in order to generate value. And the more movements, the more volatility there is in the market. And volatility is our friend. The more movements we see in the fund, the better for us. And finally, is actually helping Brand investors is market timing. We need to be careful with this because when the value of companies is recognized, this will happen in a violent and unadvised manner, and this is something that we will see happening. I don't know when or where, but it'll happen. We just need to remain patient, and patience will be rewarded. Thanks for your time. Thanks for listening. And now we go into our Q&A session. We have a QR code for you to ask your questions, and there is also physical cards for those of you who don't want to use the QR code. Hello, good afternoon. And indeed, as you mentioned, Paco, we have made available for our attendees cards for those who want to ask their questions in writing. Firstly, we would like to thank those present here and those watching us from home, and also those people who have invested time in writing questions in advance in the last few weeks. We would like to thank you all. We have more than 200 questions, and we are going to try and answer so that we can reflect the feelings and the understanding of our investors in the next Q&A, and we will identify those people who have asked the questions that are not answered during this session, so that we can provide an answer for them. Now, to start this, let's talk about a question that relates back to the crisis that banks have experienced. This is the headlines in the month of March, and the question is about how this affects the different markets. We have not banks in our portfolio, but we've seen decreases in yields going from 10 to 6 right now. So maybe we could share our perspective as to why in an environment like ours, when there's a hit to the banking industry, we also take a toll. Well, you know, the movements that markets undergo in a month are completely random. It's impossible to see a pattern of actions in changes that happen in the stock market over the course of 1 or 2 months. Actually, in the Spanish fund, we are already back to where we were before the banking crisis. For the international fund, it's true that we see there the exposure to the oil market, and it's the market that has experienced the greatest drop in the last 2 months. It's taken an impact from the banking crisis because there were fears related to demand in Europe and the United States chiefly. So that's the greatest issue, but it's not something that we can comment upon in our right mind just in 2 months. About banks, well, we want to know your opinion about the credit side of things. Would there be problems there? Well, we need to be careful because what happens in an economy when you go drastically from 0% rates to 5% or wherever they may go, some people were not adequately positioned for this, and this will impact people who are in a situation of debt. If you have net cash, at the end of the day, this has an impact, but not as much. So this has an impact, but it's buffered in a way. But if you have debt, that's an issue. It's an issue, and even more so now. Everyone was working with equity. The variable rates were not so present in Spanish mortgages, but companies, most of them, were working on a variable rate generally. And right now we don't really know how this is going to be impacting the different cases. And it so happens that banks are the most indebted companies in the planet because their balance may be 100 to simplify numbers, and capital equity of 10, very low capital. It's not that they're indebted, but they have liabilities that may get out of hand at any point in time. So these are entities that are very dangerous, generally, frankly. I don't know who may be hearing this message, but they're complicated to manage. And we, as shareholders, since maybe 20 years, we haven't been invested into banks, except for the year 2018 or 2019. I think there we were invested into regional regional banks in Spain. For several reasons, they seemed attractive and they made a contribution to the portfolio, but very quickly we were expelled, so to speak, from that industry when they allowed the banking industry in 2020 to not provision for defaults. And I, as a shareholder, I no longer know what's going on at the banks, whether there's defaults or not. So the level of regulation and control by authorities on financial institutions is so big that I don't know whether it makes sense to own shares from a bank. And something that we've said many times is that you can trust this bank, a bank, as much as you trust the state where the bank is based, because at the end of the day, banks are quasi-state entities, and we're seeing it. Without the guarantees of the state, we couldn't maintain the financial industry which is currently in place in the financial systems of Europe and the United States. So it's really complicated to be shareholder of a bank, especially if the alternative is a portfolio of 6 or 7 times free cash flows, which is something unheard of. This is what we did in the past. In the past, we were invested in banks, we sold that, and we bought Meliá. And there you can see how many customers walk into a hotel at a certain point in time. So it's easier to own shares of the hotel industry rather than the banking industry. We've received several questions about the energy industry, the energy sector. They're asking us whether our perspective is positive for the short and long run, and what is our perspective on the oil industry. Actually, last year we delivered a quite lengthy presentation about this, and this year, in spite of the fact that it's one of our biggest investments, we practically didn't touch upon it. But if you want to know more, you can go back to last year's presentation. There we talked about supply and demand, and maybe you can talk about the situation if you want, Germán, because actually we have reduced our exposure slightly, but the dynamics remain the same as we had last year. And we need to bear in mind that right now oil is at $76 Brent before the Ukraine invasion. That was the case of the situation before the Ukraine invasion. So I think we've cleared the problems there. Well, just to say that our thesis remains the same as last year. In the last 2 months, we have seen a lot of volatility for oil, and it was mentioned before. Oil and commodities, but especially oil, very quickly reflect any concerns regarding recessions. And we see that in the last 2 months, there's been a difference between the financial market, macro funds, hedge funds. We've seen that the oil prices have been dragged by automatisms because people fear recessions. And there's a difference between that and what we've seen in the physical markets. Nothing has really changed compared to what we have been seeing in the last 3 years, which is the period in which we have been more invested in this industry. So according to us, there's still an imbalance between supply and demand, and this will be reflected on the second half of 2023, as some say. We don't know when this will be markedly reflected, but we know that it's there, which was part of our thesis last year. And indeed, the price of oil is down, but we rest assured, because as we mentioned in the past, companies that we're invested in, the hypothesis for them is to estimate the cash flows that they will be having in the future at $70, at $60. They're at 76 right now, and there's still room for them to get to 60. And all the companies that we're invested in have a revaluation potential of over 100%. We're talking about companies that have very little debt with very good managers. Earlier on, we were talking about how close we are to the managers. We have met with them very many times. We are deeply knowledgeable about the companies and their assets. They have very robust balances, practically no debt, and they have very little production cost in the lower part of the curve. Even if they were to drop, they would be producing free cash flows, even down to $30 per barrel. So we think that the thesis still upholds, and the companies that were invested in this cyclical sector, which it is, are very high quality. So we are quite at ease with this. Ivan, they're asking us about Danieli. Why doesn't it have such a big net debt? It wouldn't be net cash, rather. Wouldn't this be a problem with capital allocation? Well, the reason why it has such a lot of cash is because the company is very conservative. When we talk about capital allocation risks, we maybe should bear in mind profits. We should talk about the risk, profit, and mitigating factors. Now, if this company were to be managed by employees, they would want to go crazy on growth. But because it's managed by families, we think that they will be very prudent with regard to their investments. They have increased their dividends slowly, but the increase is minimal. The company has announced that they want to invest part of this money into growing their other business, which is special steel, and they're going to put to work part of that money then. And something that the model doesn't factor in is that with rates at zero, this cash wasn't generating anything, but rates being at 3, they can be generating 3 or 4%, depending on the maturity, and they can generate more profit. They're asking us about gold and about mining companies for the next few years. What is our position? For gold and others, well, we do a company-by-company analysis. And when we invest in a company, we establish a reasonable price regarding the cost of producing that raw material. And if some company, due to a special situation, is at a discount, then we buy. It's what we're doing with oil. Right now we have a gold company, and it's not that we're agnostic. I mean, we will look around and see whether other companies are listed at the discount and then buy some more. The advantage of gold is that it is a natural hedge against inflation, clearly, but also copper and oil, ammonia too. All those are natural hedges. They come with a small advantage. The problem with gold is that, you know, you cannot really know what the fair price is. It's complicated to know it. So at the end of the day, it's like with Bitcoins. Demand depends on investor confidence and consumer confidence, especially investors, because the demand for gold is a demand for safety. And I don't know how to measure that. So we don't know what the fair price is, 1,700, 2,000. So we need to consider those companies that have a reasonable price, which equals those $60 that we have for oil. And we do our comparisons. And if it's better to go for gold, we just go for gold. We go for gold or copper or other types of companies. Vicente, about pharmas. We have a couple of questions. One about Diatrix. They're asking us whether the executive team hasn't been very much aligned with the returns for shareholders since 2020. And they're also asking us about Grifols. Could you tell us more about the situation of that company? Now, Beatrix. It's true that there's been lack of strategic definition in the last few years, but there's been clarity with their latest strategic plan. And the clarity goes in the direction of establishing a reference as to what capital allocation will be in the future. That is, for years, 50% of the cash flow will be allocated to shareholders through dividends or buybacks. Actually, right now, they're going about their buybacks. In the first quarter, I think they bought about 200 or 300 million. So we can see that there's a clear capital allocation and a clear strategy, which we lacked before. And the second point is that we need to know where we're going to go from the business standpoint. And their priorities are now clearly set. They're going to be focusing on complex generics and new innovative products. And those are the two strategic guidelines. And if we see what the company is going to be generating in the next 2 years, and then if we factor in that 50% is going to be returned to shareholders in 5 or 6 years, they would be given 60% of the current capitalization. So we think that already offers quite a lot of clarity from capital allocation standpoints and from the strategic standpoint. So we're on the right track. And about Grifols, could you repeat the question? Yeah, basically what your stance is about the company right now. In Grifols, the situation is slightly different. I imagined that we know it better just because it's a Spanish company. They work in the plasma business. It's a blood derivative. They just take the blood and retain plasma, and red blood cells and white blood cells are returned. So they work on the plasma to get protein, and they practically extracts 3 or 4 proteins used for several diseases. Now, during the pandemic, the thing with Grifols was that they had issue because people didn't go to donate blood in plasma collection centers, so they lacked the raw material, and maintaining costs for running the collection plants and the different treatment plants. The margins then shrunk, and also when the pandemic came about, they had a very tight balance. That's the first problem that they had, which was related to business, and this is solving itself now. After the pandemic, people are back to donations. They collect plasma, they purify it, they get the proteins, and they use those for diseases. And now they're increasing their profit by 11% in the first quarter, actually. But margins will wait longer because they have the clash of 6 months from the point they get the plasma and then sell it. And we will see what happens going forward. And that was about the business. And the second answer that needs to be given is about the debt. It has more debt than we normally like. This is why our position is reduced. But given that they don't have significant maturities in the next few years, and given that they're going to improve the EBITDA generation and the cash flow generation, they will be able to tackle this through an organic perspective and through asset divestment. Otherwise, they will have to do a capital increase. And the next point that we need to put on the table is about the opportunities and the challenges for this company. Opportunities come from the new products that they have in their pipeline. They have 2 or 3 interesting products that are being developed. We have done quite a lot of work in the last few months with experts to understand whether these have potential or not. And then we need to talk about the threats, because there's competitors who are also developing products that will compete with theirs. So all this needs to be factored in using probability to determine the scenarios and see the valuation resulting from this. So in the worst case scenario, we factor in the probabilities and we see the different threats, we see the new products, the business breakup, etc. And we determine the potential. If the potential is significant, then we put it in the portfolio. And we saw that in the worst case scenario, they had significant potential in which threats would materialize, they would go for a capital increase, but they had good potential. So if we consider that the potential for the worst case scenario was good, then we put it in the portfolio, and that's what we did. And going forward, we hope the margins will improve in the next 3-4 months. Cash will be generated, and we'll see whether they can offset the investments from the 2 levers that they have. Business in China, because they have stakes at the company that's Sankar Gas. They do the same as them, but in China, there they have significant stakes. And then they have other non-core businesses, such as the diagnostic division, and thanks to that they will reduce the leverage. The objective is to divest 1 or 2 assets this year, and then next year they will be at the leverage for 5 times EBITDA. This is the situation, but many answers have to give in to several questions. So how the business is doing, what happens with opportunities and threats, and what's the balance situation.
We also have a few questions with regards to Carries. How's the company faring? What's their performance, and what was the reason why they had such bad results, and why don't we consider them a value drop? No, actually Carmen is not here, so I will be her backup. Well, Carries, as we all know, is leader in the UK and in other 6 European countries for electrical devices, and they are actually doing very well. And the business is the lead. The company is the leader in the market, online as well as in stores, and they're going above what was expected. The economic situation in the Scandinavian countries, especially Sweden, we see that the biggest owner of office spaces has gone down in the last few days. So the economic situation, especially in Sweden, is not very good. So there is a war on price, and Carry with their brands is the leader in those 4 Nordic countries, so they're going through a bad cycle in Nordic countries, especially in Sweden. And this is just a circumstantial crisis, because they have had very good margins in the last 20 years with an amazing growth, a very well managed company in the northern countries, and there are no reasons for us to believe that that won't be the case once this small storm has passed, especially in Sweden. And it is difficult being leader in your business in a sector that has always seen growth, because you know that household appliances and other electronic appliances, there's always growth, not a great growth, because as we said, in the countries that we're talking about in Europe, we don't grow at very high volumes, but there will be growth. And when you're the leader, it's very difficult for that to be a problem. It is a company that cannot be considered as a value trap. They will always see a growth, and Carries, I think that it will come out from this storm in a better shape than they were before the crisis, just as it happened in the UK. We don't think this is a mistake. We don't think it is a value trap. It's just a cyclical problem. And they're also asking us about Korea, and more specifically they're asking us about the corporate governance that is going to improve, because the Korean government is now promoting certain measures, especially due to the problem of voters that need to be happy. Could you give us more details about how they're doing this, how they're improving corporate governance?
The question is, what's the method to improve the corporate governance?
Yeah.
Okay, wonderful. So I think from what I read, a few parts. First of all, I think it's the first time that I heard or I see the government official come to speak to investor, global investor, and the idea was, trying to make registration process easier. So if you are a foreign investor, now you don't need to have a code and you can invest in Korea. So that's one, make it easier. And secondly, I think they are trying to, it's still not yet done, but they're trying to put some in the law that make it very difficult for the company in the past who did bad things on the corporate governance. For example, they will make it a law that you cannot have a subsidiary that making more than X% of transaction with the parent company. So that's also the other one. And also, I think also they make the vote in the past. Perhaps they cannot. The minority shareholder will have to go to the conference to vote, but they make now a mandatory vote in the electronic format, so everybody can vote to avoid any disruptions. So that's few things I think about for the moment. But basically, it was the idea. They try to push it very difficult, and then to encourage the company to do more capital allocation that benefit shareholder friendly.
Bueno, lo resumo rápidamente.
Going to summarize that quite quickly. So the first thing is that for the first time, members of the government are not meeting with foreign investors to talk about how to improve their relationship and how things can be improved. And they're also reducing the possibility for companies. As you know, in Japan and Korea, company groups are very, very big, such as Samsung and so on. They're very much intertwined, subsidiary companies and mother companies are very intertwined. So they're preventing for movements between different companies in conglomerates to take place. And they're also improving the voting systems for general shareholders meetings. So there is an awareness by authorities with regards to that need for change. And as he explained during his presentation, we do see that, we can feel that, especially the big companies, which are the ones that set the example, such as Hyundai or Samsung or LG. They're repurchasing shares, they're now amortizing, so they're actually following the right path. It does resemble what is currently happening in Europe. Okay, and we're being asked about the technology that we announced last year, the Atalaya technology. So, Juan, how has that evolved?
La tecnología se probará en...
Well, the technology will be launched industrially during the second semester of the year, and we don't have much to share with you publicly here. I'm afraid I can't say much more than that.
Juan, si no podemos...
Thank you, Juan. Then maybe we could answer a question that a couple investors are asking. Well, we could say one thing, which is that our investment thesis, I mean, technology in our assessment is just symbolic. So correct me if I'm wrong, but yes, in our valuation, and the 240 that we have in our funds, we do not include that technology. So if it is successful, and we do expect it to be successful, the valuation will go up. But if it's not successful, it will not lower our valuation. So as I was saying, we're going to ask a question that a couple of investors have been asking about the yield since 2017 for those investors who started with Cobas at the time, and the yield that they have. They're telling us that they're not satisfied. Some of them are demotivated, and they are not seeing that increase, that strong increase that they expected to see. It's not really a question. They're just showing us that they're disappointed with the results that their portfolios are having. So what could we add to what has already been said previously? And also linked to this, we have a couple of questions. For instance, when will we be reaching a yield such as the one that we were mentioning previously, that will be around 8 to 10% in the next few years? Will we have to wait 10 years for that yield to take place? And the portfolio that we currently have, is it a winning portfolio? Will it be worth it to wait for it to reach that objective value? Well, I thought I had answered that question during my presentation, but I'm going to highlight it again. 6 flat years is not rare. It's not the first time that happens to me. Maybe not people in Cobas, but it has happened to me previously with public funds, and actually during longer periods than that. And that is part of the investors process. That's what it is. It's true that the market has had better results this last few years. That's a reality as well. But we have had a problem since 2018 till 2020, mainly due to mistakes that we have already mentioned, and also because 2020 was a very negative year for our investment method. And we have recovered those losses during these last 2.5 years, and I don't see the reason why we won't have a profitability that won't allow us to get to 10-12% on a yearly basis in a couple of years. I'm talking about from origin, obviously, and I think that will be the case, taking into account what we have in the portfolio and due to what companies are doing and what we're doing, because we're doing everything that can be done. We're not just sitting and waiting. And that will come about. I don't know when and how, because I don't have a crystal ball, but I know that it will happen. And the only thing I can do is just explain what it is that we do, and explain what sorts of companies we're investing in. And you have to be happy with those companies. And as for the value of those shares, well, they'll move when they have to. They ask us if we're covered with regards to dollars, because we always said that it was cheap considering the interest rates. But now that the interest rates are going up, has that situation changed? Yes, quite recently. When the dollar went up 110, we have eliminated that coverage. The PVP that we had, is a reference. It's the index that allows us to compare prices when currencies are offset, and it's around 110. It can be $115 versus euro, and we're at a neutral level, and we have reduced our dollar exposition. We have gone from 30-something% to 20-something%. It's a much more moderated situation, and so we have just let the dollar run freely. And we have some questions with regards to energy. Some companies that have left the portfolio, such as Cosmos or International Southwest, I think you said, and what were the reasons why we decided to no longer hold them. And they have recovered their value quite faster, much more than others such as solar that are a bit more stagnant. So if we could generally talk about what it is that we have done with that part of the portfolio. Cosmos is in the portfolio, yes. We haven't, it's not left the portfolio, but we have sold some of the shares. Well, Seaways, as in any oiling company, they have reached their objective value, and there are now better opportunities. When do you sell your shares? Well, when you have better things to invest in. And it's true that we have sold Seaways, and then it has gone up, but now it's gone down again. And that the normal and reasonable situation would be for us to sell when the company still has a 30 to 40% potential or updrive. So, but we were Seaways shareholders for 3 years when the company was at around $15-20 per share, and when the dollar has gone up to 30, we have sold our position. Seaways is a cyclic company. It's a very cyclical sector. It's not sector where it makes sense to be a shareholder for 20 years. When the company is so volatile, you have to come in and come out. It's just like Acerinox. During the last 30 years, we have gone in and out 6-7 times. I mean, it's a very good company, but you have to optimize your opportunity cost by getting in and out when you have to. And as for oil companies, well, some go faster, some go slower. Some companies such as International Petroleum, they have multiplied by 6, by 7. We have sold our shares, and in others, despite the oil price going up, the companies have just gone up 20%. So we have gone from oil to other companies. So that's the constant movement, going from some companies to others, finding those that have a greater upside or that have a greater discount compared to their real value, to their face value. So obviously selling when they have their maximum price is absurd, because you never know when that moment is going to happen. What can you tell us about A+? Well, in A+, it's a possibility, and it's a company that we find interesting, that has some entrance barriers, and we have increased our position in A+. We now represent 3% in the Spanish fund. We thought that the valuation was good, and it's what it is. It's a company with interesting market positions, and that's it. And if there is a takeover bid, then we'll see what we do. But we will always compare it with the alternatives that we have in the Iberian portfolio, and that's it. And Domenico is asking us about Cheer. There are 2 questions about it, actually. Are there any risks? Do you think that the Benedetti family could at some point repurchase shares, or do something in that sense in the company, buy back the shares? And aren't we bored because the valuation is not going up, is it? Well, the greatest risk that we have in Cheer is actually that we don't see there is no takeover bid that is close to our objective price, but our target price. But it was a company that needed to sell their shares in Sogefi, but as you know, a couple years ago we had the problem with car supply, which is something that impacted the whole sector, and Sogefi as well. The company changed its management team. They have been doing a great work this last few years. The profitability went up in Sogefi, and now they have something to show for if there were a potential buyer. And on the other hand, the business of elderly homes, you know that COVID especially, well, actually entered Europe through Italy, in the north of Italy, where they were, where Cobas was, and they were impacted by it. But now they're recovering from that situation, and we don't think they will go back to the levels that we expected, but they will go back to some very decent levels. And we think that that should be felt in the shares. And now, what is the company doing? Well, they're buying back the management team. The family are buying back the shares now, little by little. And as I was saying, the worst thing that could happen to us right now is for a takeover bid to take place. It's now at 0.39, that they were to do a takeover bid at 0.40, 0.50, but we wouldn't lose any value. So I don't know if you want to say something else, Luis. Well, Paco and I were there in the mid-March visiting the homes, and obviously this has nothing to do with everything that happened with Orpea. You know that in Orpea they have done all sorts of things, and well,
we need to clarify that Orpea is a French leader for nursing homes, and there's been a slight scandal in France. It doesn't look like they've done anything excessively serious, but they weren't managing their nursing homes in an optimal manner, and their shares collapsed. Actually, they lost all their value. And the main European competitor, which is also French, Korean, has lost 80% of its share price. So when your main business, Cheer in our company, is also nursing homes, it takes a toll. It takes an impact on the image of the different nursing homes across Europe too. But we think it's temporary, as Ivan said. When nursing homes are full again, and they're already doing so, they will go back to their good old yield. We've received several questions also about Técnicas Reunidas, because they've done a capital increase very recently. And this customer in particular has done its capital increase, and we want to know about the different risks: the execution risk, that risk, and the business risk that this operation entails from the execution standpoint. Of course, good execution is always essential for the profitability of the company, but these are large-scale projects with technological and logistic risks with low margins, and this could negatively impact profitability. From the standpoint of debt, the debt of the company is important, significant, and this capital increase intends to reinforce the balance. Nonetheless, the company apparently could have some issues refinancing their operations. And finally, we have the business risk. The infrastructure industry and energy is subject to a lot of volatility, regulatory changes, etc., changes in prices. What can you tell us about it? Well, Técnicas Reunidas, not only this company, but also the whole industry, which we're very much acquainted with because we've been shareholders of all competitors of Técnicas Reunidas. It's the sector that we're very well acquainted with. Sofab, Technip, CGG, Subsea 7, that works on oil fields, and there's been a bit of a struggle between the OPEC and the American sale. The prices dropped, and then COVID came around. So it's been 6 or 7 bad years, and in a way, this has given rise to this lack of investment, which is one of the basic pillars that we follow in investing in the oil and gas sector. We think that Técnicas has fared quite well. They have weathered the storm quite well, and they've done a capital increase. We publicly supported it, and this has to do with several reasons. The reasons for this capital increase seem acceptable, and we know that Jadot family is behind Técnicas, and they have been part of this capital increase with their money, and they have fully supported it. And we really think that the capital increase has a good rationale behind it, which is to have a healthier balance when facing the massive investments that are coming towards the oil and gas industry, especially in the Middle East. And it's not certain, because nothing is certain in this life, but uncertainty is low. Because in the Middle East and Saudi Arabia and United Arab Emirates and Dubai, Qatar, etc., these two countries, these two first countries, have implemented a strategic decision, which is to increase by 1 million barrels their annual production. And this is going forward. I mean, the execution plans are already in place and they're going to be implemented. So those investment plans are the future income that Técnicas Reunidas and their competitors will be perceiving. And it's not just Técnicas Reunidas, it's also the competitors, and we're following this data. And we are seeing that the investments are materializing and they're being implemented. It's imminent. We think that many billions are going to be invested before the year end or in the next 12 months. Técnicas Reunidas will get its share. About debt risk, we think that with the capital increase, this will be solved. It's 150 million, and there's no longer a debt risk. Now, about the execution risk. That's a good question. In the last 2 years, Técnicas Reunidas has done a significant effort after COVID to work on those historical contracts that they had amidst COVID. They've renegotiated those contracts, and they made it at the end of the tunnel with reasonable margins without losing money. They have very large contracts, and risk of execution could be in place there. And this has actually happened to Petrofac, one of the competitors. They're in a very complicated situation, the way we see it, but Técnicas has managed to renegotiate these contracts, and it seems that it's quite likely that they will be able to execute these contracts and finalize them in a successful manner. Now, about the business risk. Indeed, engineering and construction execution, project execution in remote or difficult jurisdictions in the middle of Saudi Arabia, we're creating a gas plant that is worth 3 billion. That comes with risks. But we think that Técnicas Reunidas has historically shown that they know how to go about these things. It's not just them saying it. We see it. And we know that the customers of Técnicas Reunidas are very happy and satisfied with the execution of projects by the company. So there's a certain degree of contingency in the different projects executed. And we think that Técnicas Reunidas will be successful going forward in their projects that they execute. Some projects will go awry, some others will be upset with good projects. But from that perspective, we are reassured, and we think that those three elements have been tackled. Just a remark from me. During COVID, Técnicas Reunidas has done 2 building works with the 2 key customers that exist in this industry. Exxon, the key private industry, a private company in this industry. They've done a gas plant in Asia, and they've also done works in Saudi Arabia. So they have served the best private customer and the best public sector investor too. So it's extraordinary what they do. Something that I left unmentioned that I'd like to mention is that when we talk about the energy sector, we're truly talking about the energy industry. We're fully aware of the fact that there's a transition in place, and we'll see how long it takes, whether it's radical or not. But these companies are very well positioned to make the best of this transition. We need to be aware of the fact that hydrogen, carbon capture projects, converting waste into methane or hydrogen, all these projects are moving many millions of dollars and euros, and the engineering complexity is huge. Maybe 1,000 people will be involved in each project, and you need engineering to execute these projects. So precisely, Técnicas Reunidas or Madrid Tecnimont, companies of the like, are very well positioned to be the tool, or to be the hinge, the transition for this. no company is going to emerge out of nowhere to support customers in their energy transition projects. So we mustn't forget that Technicas and other engineering companies are very well positioned for the energy of the future. We don't yet see the yields because it's still budding, but in 5 years' time, we'll rest assured about this because it'll be a very important part of their P&L. Nico, they're asking us about whether it's safe to invest in China and whether economic freedom is not on the decrease. Invertir en China?
I was joking.
Well,
Minkun actually is from Taiwan, as you know. So.
Let me think. Well, I think it's a difficult question that it depends. If you invest in BMW that has business in China, well, you have to. Well, I will not put 100% my asset in China, to be frank, because there is a possibility something bad could happen. But you know, it's a big economy, and there's a lot of growth driver there. So I also don't think you will have to go out of China right away because of what you read on newspaper. Because I think the newspaper, both the US one and Chinese one, are very biased. So the reality is in the between. So you always kind of find the opportunity in such a big economy. So I don't think it's fair to say that you will have to get out of China because of what you read. But yes, there's risk that we are observing every day, and I don't have a better information than everybody else in this room, I think.
Sí, lo que nos cuenta es que hay que tener una visión un poco más balanceada.
But you were saying indeed that we need to have a more balanced perspective than what we see in the Western press. In some sectors, life is made difficult, and in some other sectors, it's not the case. People from there perhaps don't perceive such a big risk to actually leave immediately. They are asking us about the growing tension between the United States and China over Taiwan that produces over more than half of the chips worldwide. Could this lead to an armed conflict with the different restrictions and the impact that this would have on our funds? Well, I don't know. I don't know. It's like when Russia invaded Ukraine. I mean, the derivatives, the results are so difficult to foresee. That's hard for me to think about how this would impact us. I don't have a crystal ball. We don't have a crystal ball, frankly.
Like the China-Taiwan conflict into the funds.
Okay.
You know,
no,
go ahead.
Well, I think nobody knows, but one thing I can point out is because Taiwan has a very strong semiconductor industry, like TSMC is kind of produced more than half of the chips in the world, especially in a very advanced one. And that's why the US want them to go to the US to set up a factory there rather than in Taiwan. And then I don't want to have anything to happen, but if you think that way, Samsung, they have foundry business, they have a memory business, that if that happens could potentially become very valuable asset because the supply will be disappear in a very quick manner or being disrupted. So that could be benefit in that way, I think, possibly.
Sí, lo que comenta Minkun es que, por ejemplo, un caso positivo para...
Yes, Minkun was saying that this could have a positive impact on Samsung Electronics if this were to materialize, because it consumes, it competes with Taiwan Semiconductors, and this also would have an impact on memory chips too. So this could come with advantages for some companies. So I think some other companies would run into trouble. But, you know, when investing, it's impossible to tell the future. It's impossible to tell what's going to happen across the globe. It did happen with COVID. So what's most important is how you react. If something positive or negative happens and has an impact on our listings, well, if the way it impacts, it's nonsense, then you need to make the best of the opportunity. You need to make the best of volatility, as we mentioned before. And for some companies, this will take a toll. And for some others, it won't. It will just benefit you. This is what's happened with the Ukraine war. For the LNG chain, this has been beneficial. And how could you foresee that this was to happen? I mean, you should invest even 1 year in trying to foresee geopolitics and conflicts, because it's impossible to foresee positive or negative impacts, but you need to react consequently. Sadly, there's been a war, and it's happened that the share price for some of our assets has increased. We've sold some some assets or some shares. Because of that opportunity. Técnicas Reunidas still suffers from COVID. Who was to predict that the works in Saudi Arabia were going to come to a stop for 6 months with the cost that this has brought about and the problems that this has resulted into? What we need to do is to act accordingly, to react accordingly. Now, since we're talking about conflicts, they were asking us about Babcock. Why generally companies in the sector have behaved rather than them? Why are they not picking up? Juan, why? Who is to blame for this? In the United Kingdom, there's another company that precisely manufactures the military equipment, including things that Babcock does maintenance for. So if you increase military expenditure and you reach agreements with Australia, there's a very significant agreement between Australia, the United States, and the United Kingdom. And if Great Britain is partly in charge of building those nuclear submarines, there's a comparable company that makes those submarines that's going to benefit more before you make them and then you maintain it, which is what Babcock does. So I think that temporarily the market is factoring in that value. It's valuing precisely that. And to a certain extent, it's a mistake on my end because we had identified biosystems. It was the time was ripe to buy it, and we didn't jump into it because we decided to buy it with greater certainty margins. We didn't really know what the final agreement was going to be between the three countries. We missed out on that, and that was my fault. But something that we're more clear about is the long run. Basically, the submarines are going to be created anew. They're going to be built, and they're going to be built in military bases that have important Babcock operations. So this is a company that has gone through the darkest side of COVID. They're reducing that faster than we expected. We want to see the details. They will be published in a month and a half time, and then we will be able to speak with greater precision. But things are in the right path. So it's a matter of time, I think. First, Biosystem has picked up, and when we see the results and the good performance that they're having, then Babcock will pick up too. That's the most logical approach that I can have to this, to trying to ascertain why the market is behaving in this way. But we know what companies are worth. What prices will do is more difficult to tell. Jose Enrique is asking you, the managers, what motivates you to work for Cobas? Okay, I'll cover my ears then. Should I break the ice? What motivates me is that I am lucky because I work doing my favorite thing. It's also my hobby and I get paid for it. So motivation comes by default. That's what motivates me. And the truth is I learned every single day. You're constantly learning in this job. You are visiting businesses, companies, and you never cease to learn. If I stopped learning or I stalled, then it would be a different story. But I learn more and more day in and day out. And the team is very good. I love the work environment. So it's so positive for me. Paco, could you please cover your eyes? Yes, they're covered. Well, I've been working with Paco for over 20 years, and it's a great pleasure to work with someone who's so professional and who has such a positive human side. As Juan said, we learn day in and day out, every day more and more. We know more about the industries that we follow, and we're paid for that. We're paid for doing something that we love. My wife says that I'd rather be at the office than at home. What I like, and it's something that I was telling to some students that I delivered a presentation for 2 or 3 weeks ago. What I told them was that I like doing my job. Contrary to everything else in life, you get paid for being right. In other areas of life, you are right, and that just makes enemies for you. If you are too adamant about what you stand for. And it's the other way around here. You get paid for it. And from the standpoint of the team, something that I really like is that you can get to know about many things and in quite good depth. And that's a feature that Cobas has and maybe some of the companies don't. You can be with many companies that are there 1.5%, and sometimes companies wonder, okay, why don't you concentrate further? But that's the reason. The reason is that those that are newer here have been with us for 10 years. And this allows for great diversification. The potential that we see there, it's quite widespread. There's no company that especially stands out or that's especially hidden. I mean, it's quite good, well balanced, and I like that. And I think that if we were to work separately, we would do worse.
Pregunta un poco más.
I have a bit of a more polemic question, which is with regards to our half-year results. Why don't we show how our portfolios are varying from quarter to quarter? Well, we come here and we talk in depth about the companies in our portfolio. I was looking this morning at the portfolio last year to see what the changes have been, and it's relatively similar to last year. It doesn't change that much. So the level of information you provide with the quarterly movements is actually quite small. It's not that interesting for investors, and we don't really want to give information to third parties. The less information we give to third parties, the better. That way we will be able to purchase a share on January 1st, and we will still buy in May, and we'll have it until the end of August, and we will have 7 months for us to purchase those shares. But if we tell you what we're purchasing and selling every quarter, that makes our work more difficult, and it's a lose-lose situation. So we would rather provide the minimum information required by the legislator, always being transparent and absolutely open, as we always are during these conferences. I wanted to also make the link with another question about the positions in the different companies that we invest in, because in our website you cannot see the companies, but you can see it because you have the half-yearly report where we have a breakdown of all the companies, so you can see those companies as well. Well, and you can just type Cobas Internacional CNMV, and you will have our portfolio broken down by companies on a half-yearly basis. Paco, what do you think about creating a portfolio that is 60-40, 60 fixed income and 40 equity? Do you think that everything should be in equity? And then there is another question that was asking whether it was a good moment to invest now. Well, the first question, I need to clarify that before I give you an answer. It depends on how much we need the capital. So the question is not yes or no, but rather, do we have aversion to volatility? But the question is, do we need that money for something or not? If we need that money for something, for some expenses that will come in 2-3 years' time, then I would recommend to have a Cobas Renta or something similar. something that has a clear security that you know that you will receive the same amount that you invested, a bit more, a bit less. But I would never do 60-40 if I need that money. I would never do, I wouldn't do equity 100%. I think that the enemy of savings is inflation, and I think that fixed income is the assassin I think inflation is the assassin of fixed income. So I don't even think about 60-40 or 80-20. Every coin I invest, the next day will go to the funds. And that's when we get to the second question. What's the moment? The moment is right now. Right now is the right moment. I never think what the right moment will be. A portfolio that has a 150 upside is something that I am going to invest directly in, because that upside is going to be reflected at some point. I don't know when, but it will be. And that was my experience. For instance, what happened in Spain in the 90s. We were from 1987 till 1992, where the flat stock exchange and even dropping. I think it was from 320 to 280. That was a general index, and it's actually in the books. And it's in my book. I told you about that when I wrote it. Those were very boring years. And then the stock went from 300 to 900 in 96, 97, 98. So it tripled. And you have to be there. And I started working in 89. So from 89 till 92, 93, well, it was very flat, completely flat. And then in 93, 94, well, 93 was a good year. 94 it went down, but the good ones where everything tripled were 96, 97, 98. Those were amazing years. So those were the years. Since 87 till 2023, those were the years. 96, 97, and 98. Those were the years. So since 98, the Spanish stock is absolutely flat, or has even dropped. So you have to be there when those 96, 97, 98 happen again, so that you have the yield that that cycle will provide you with. So the moment is now. If you don't need that money, you have to invest it. Okay, Gustavo thanks us for this initiative with the employment plans, both for companies and for freelancers, the ones that we have been talking about. But he asks us what makes the difference. What's the difference with these Cobas vehicles and the ones that are already in the market? Well, what we provide is management and a big commercial network. And what we provide is the management. We don't give you pans and pots as a present if you invest in our pension fund. And we have an upside that is there. And it will come. It will come, and it's not a bad time to invest in them. Do you think, Paco, that you will stop managing the funds? No. No, well, I do foresee, and we have already announced that this management fund will not be a signature management fund. I'm not retiring. I've already said that. No, this is collective management where we all participate. We all participate in the decision making, and we will end by changing this as a signature or boutique management to a collective management, but because we decide things, all of us together. And Rocío is asking us if you will follow Warren Buffett's style. Do you have the same motivation, energy you had when you began? Yes, I do. And actually, it bothers me because I would like to do other things that I can't do because I'm focusing too much on this. And we're also being asked, how can we learn trading from scratch with financing? Trading with financing? Well, I don't know. I'm sorry. Is that the real question? Yes. We could maybe ask him to go to Valley School. I would try not to do trading, because if you don't invest in the long term, it's just like the lottery. It's like the casino. Just by analyzing the companies in depth and with some patience, sometimes a lot of patience, can you get good results. Because trading, I don't know how that is done. We buy at a low price and we sell at a high price. And We thought that we were going to have a 2 hours conference, and we have actually gone beyond that. So if that's all right with you, we will answer your questions, your unanswered questions. We are the investors relations team, and I don't know if you want to share some message as a conclusion, and if not, we will just stop there. Well, thank you all. Thank you for your patience, and it will be rewarded. I am sure it will. No doubts about it. Thank you very much.